back on Smart Markets, and let's take it straight to breaking news. Just coming in as expected, the Federal Reserve has decided to stay pat on rates. It's left its key interest rates unchanged. Not like that's come as a surprise, because keep in mind, this is what most in the market was expecting. What we will really look to see is whether or not there's any forward guidance on the kind of timetable the Fed is likely to follow as far as further rate hikes are concerned. A quick look at what's happening really as far as markets are concerned. Remember, going into this event, you had the Dow actually just about managing to hold its head above water and breaking into the green. Of course, Apple had a lot to do with it. Right now, you've actually seen the markets in the US sharply pare those losses. We will, of course, wait to see what it is that Ms. Yellen has to say as far as, the state of the economy, or even what the tick up in crude oil prices could possibly mean for prospects of the US economy. In fact, let's waste no time and take it across to our panelists who are joining in on the show. We've got Manish Singh of Crosspitch Capital, Nandini Ramakrishnan of JP Morgan Asset Management. In just a bit, I'll have Invesco's Arnab Das join in, and so will Priya Mishra of TD Securities. First, let's take it across to Nandini. Nandini, of course, so far we don't have much in terms of, what's happening, but let me just read out to you what I know. As expected, the Fed has decided not to go ahead and tinker with rates. They're saying the labor market improvement is actually very encouraging, given the signs of slower growth that, of course, exist. They've also removed the reference to global events that are sort of posing risks to the outlook. So that's pretty interesting. On the face of it, Nandini, what are you making of it? One would imagine that if they're not alluding to the worries that existed on the global front, somewhere they believe that those are definitely on the wane.
Yeah, so first off, I do think this was very much in line with consensus, no change on the rates. But I'm particularly intrigued by, as you mentioned, the removal of the global growth concerns, because, 3-4 months ago, we were very concerned about volatility in markets and financial systems in China, for example, a very weak commodity complex, so many emerging markets struggling. And now there's been a little bit of stabilization in some of those trickier parts of the global economy. And it's actually within the U.S. that, although the labor market is very strong, inflation is nearing target, you do have a close eye on some of the manufacturing data, credit conditions data that the Fed might be waiting. So given the fact that they're going to have, as they say, 2 rate hikes this year, there's still room for June and some in the autumn or even December going forward.
Okay, let's bring Manish in on as well. Manish, the other lines that I've got now, they've said inflation below target due to cheaper non-energy imports, household spending has moderated, and investment and net exports continue to remain soft. And of course, the fact that the market-based inflation compensation measures still remain very low. But as Nandini was saying, what's very intriguing is that, they seem to now not be very worried about what's happening on the global front. Are they sort of running ahead of themselves here? Because one would imagine that it's not like all global risks have evaporated.
Yeah, so Tanya, to come back to your point about they have removed the reference to international risk. Now, that is in a way understandable, because look at what Eurozone has been doing, look at what China has been doing. So it could be partly because of that. But other than that, nothing has changed. So I wouldn't see this statement as hawkish. I would say it's more a reflection of what is truly in the market, what you have seen over last few weeks. So for them to remove a reference, I think it's okay. I think the Fed is still maintaining where it was before. And we will see what happens in the trading hours, and then what happens with the Bank of Japan announcement. Because as far as I can remember, this is the first time I'm looking more to Bank of Japan announcement than a Federal Reserve announcement. Given what is at stake in their announcement.
Yeah.
So we'll see what happens. But I would say that it is status quo for me from what I have seen so far.
Okay, it's status quo. So let's then talk about, because we haven't got much from the statement yet, and that's very typical of the Fed, isn't it? Just sort of leaving the markets hanging and being very cryptic about things. But let's talk about what has changed from the last time that we had an FOMC statement, Manish. And this is a question for you. The fact is that oil prices have really started to recover. If you look at just US crude, it's up, 21% from the 16th of March, which is the last time we had an FOMC meet. prices were at $36. Today, they're at $44. How do you believe that is going to change the sort of economic outlook? Because one thing's for sure, it's going to push the inflation closer to that desired 2% mark.
Sure. So let's look at two aspects. If you look at the GDP growth aspect, then the number in US is not looking very good, because the Q1 number, which will be reported tomorrow, it seems it's going to be around 0.4%. Now let's look at the asset side of the equation in terms of equity prices. Now, if we believe that oil is at $45 and we are not going to see a big sell-off or maybe a small sell-off, then the worst of selling driven by low oil prices and by sovereign fund may be behind us. So what it says is that maybe your equity prices will find some bottom or some relief. So that is positive, risk positive. But then on the GDP side, you're not seeing a big number. And that's exactly what Fed is looking at, because even if the equity prices are doing okay, if the GDP numbers don't do very well and the inflation doesn't pick up, then they will not be in a hurry. To me, basically, from the March statement and from the Economic Club of New York speech that Janet Yellen gave on 29th of March, things have changed. I mean, Fed is not looking really to change tack again very quickly, because she sounded very dovish and she looked at very long-term concerns. She cannot be looking at changing the views once again in just 2 months' time. So I still maintain what I have seen said in the past, that for me, the earliest Fed is going to raise the rates is probably going to be July. I don't even see a June hike.
Okay. Nandini, what about you? What are the probabilities that you would sort of ascribe to a June rate hike? I also want to just, very quickly make a mention of what else has caught my eye. Basically, from what I've understood now, the statement says that risks are balanced. The Fed will continue to be data dependent. So then one presumes that, rate hikes are very much on the table. Now, Nandini, the question is, when does the next rate move come? Does it come as early as, say, June, or as Manish is saying, that not before July?
I do think it's tough, as we've mentioned earlier today, that the factor is the Fed raises. They're dealing with other central banks around the world, like the Bank of Japan and the ECB, cutting rates, buying more assets than they've ever bought before. So a June hike, while still on the table, I do think is less probable of a hike than a hike. So I think July perhaps as well, but I would say markets and our team itself are pricing in one, at most two rate hikes. June would be the very earliest, but something like fall or December would be more appropriate. I do think you have to keep in mind they'll still be data dependent, so that can all change. We do expect a pretty soft GDP print later this week, tomorrow, but if data does pick up a bit, if PMI, services, and manufacturing pick up, perhaps a June rate can be justified, but at the moment, less probable for a June hike than we would say maybe for the fall.
Mm-hmm. Okay, since we're talking about GDP data and that's on tap, Manish, would you sort of agree with that school of thought that believes that at least 2 months ago, when everybody was talking about how there's a chance that the US could very well slip back into recession, that now is not going to happen? Or is there a possibility that we could be staring at some sort of situation this year?
See, I think that recession is not on the cards. And the reason I say that people always make this mistake that, remember, past many years before 2008, the normal rate of GDP growth was around 3%. And we are not seeing that now. So we are in a low growth environment, but that does not mean that, GDP is going to go back into recession. To give you one more point, if you look at before 2008, there were only 4 or 5 quarters when you had a negative GDP growth for a quarter and the US economy didn't go into recession within 12 months. This time, since the recovery of 2009, we've had 2 quarters where you had negative GDP growth and US has not seen a recession. So my view is that, we are in a low growth environment. I don't think recession is going to be a factor, and I wouldn't be worried about it. It'll be a low growth environment. And let me say one more thing. If the Democrats come to power in November election and you have fiscal expansion, you're really not looking at recession until 2018 maybe. So that is something which will play out later on, but I am not in a recession camp happening anytime soon.
Okay. So Manish, then by that same logic, I would imagine that you don't think that, at some point in this year, the Fed is going to have to do a U-turn and go back on its decision of actually hiking rates in the first place in December, correct?
No, I don't think so. And therefore, Fed is going to be very cautious. They don't want to lose confidence of the market that they have lost track of what they are doing. So, and therefore, they will tolerate slightly higher inflation than go and be in a rush to reverse the step back, because that will be very damaging. So I don't see them doing that.
Nandini, then the question is that how many rate hikes are we going to see this year? Because we already know, Ms. Yellen has sort of pruned her forecast from the 4 that she talked about in, last month. She said that, look, now it's only going to be 2. And now, as you yourself were saying, that, it could be as late as, say, December when we see the first rate hike happen. So in that sense, what would you say? Is there a likelihood that we're even going to see 2 rate hikes from the US this year?
So I think 1 or 2 is the maximum. I certainly think there will be 1 at least at some point this year, or else you've gone a full year without a rate hike, and that's a very odd and not following historical precedent in terms of being in a rate hiking cycle. So I think that would send a very negative message actually to markets and economies if there's absolutely no rate hike this year, as that vote of confidence in the economy is part of what we read into when the Fed is ready to raise rates. And I would just echo another point in that, speaking about recession risks, while you are seeing a bit slower growth, and we certainly expect a softer 1Q16 GDP number for the U.S., the expansion from start to finish, so since the crisis to now, has been a very low but stable growth environment if you take the general trend. So I think there's still room for the U.S. economy to keep expanding and still be strong, and I think the Fed is going to keep that in mind when raising rates at least once in this calendar year.
We've also got Priya Mishra, who's the head of Global Rate Strategy at TD Securities, and she's joining in on the phone line. Priya, thanks for taking time out for us. As we were discussing with Nandini and Manish, would you sort of agree that what we've seen so far, would you say that it's a hawkish statement at all? It's interesting that the Fed sees merit in actually dropping the global risk a bit. Manish says it's no big deal. Are you surprised at all?
So I think it's a bit of a nuanced message that we got from the Fed today. They did drop the risk word, but they actually left monitoring, or they added monitoring global economic and financial developments right at the end. So they're closely monitoring these indicators. So it tells you sort of their third mandate, global factors, is still out there. It's less of a risk. I think they're actually shifting the goalpost a little bit back to U.S. growth. They actually did nod to the fact that U.S. growth has come in weak. Now, is that a seasonal issue? Do we get a big bounce back in the second quarter? I think that's what they don't want to opine on. So to me, it's a very balanced type of statement. It has something there for everyone. It's sort of reinforcing uncertainty. It's reinforcing data dependence. But I think June is certainly off the table. The market was, the rates market was pricing about a 20% chance of June. I think that should go down because we just won't have enough second quarter data for the Fed to be able to sort of say that, growth is rebounding. Even July looks tough. Whether we get a hike this year, I think they'd like to hike twice. The market is not pricing that in because the market prices in a sort of weighted average probability of outcomes. And there is a reasonable chance the data has been weak so far and maybe doesn't justify 2 hikes this year. So if we're pricing in 1 hike, to me actually that's relatively fair. And it all depends on, do we get the second quarter rebound? We had a very warm winter in the U.S., so it's not clear where that first quarter weakness was from. But yeah, it's marginally hawkish. They did drop risks, but by throwing in a few other things, I think they actually tried to balance out that hawkishness, which is why the market is solidly unchanged in rate terms pre the statement to now.
Well, that's true. But what is surprising is that we're actually seeing equity markets. They've, reached the day's high because remember, you had a pretty sort of slow start for trade, especially because of that Apple overhang. But it's interesting to see that at least markets, both the Nasdaq and the Dow right now on your screen, they've actually bounced back pretty nicely. But Priya, coming back to then, what the outlook for the dollar is, and if you could sort of just tie it up with what that means for moves then in emerging market currencies, especially, say, the rupee.
Right. So I think the dollar, I don't know how much of it was a Shanghai Accord concept, but I think there has been greater appreciation that if monetary policy is sort of pushing on a string here, if every central bank is going to try and engage in currency wars, it's going to be fairly counterproductive. So that's why I think you're seeing the Fed sort of stepping back, the Fed acknowledging global factors. And so the dollar, I think, is likely to be very range-bound, which therefore is positive for EM currencies, I would say, particularly given, I think, also the rebound in commodities. We're actually fairly positive on EM, India being one of them. But a lot of that is just this thought that the U.S. cannot be this island of prosperity with the rest of the world slowing, I think the Fed acknowledging it helps the dollar be contained.
Okay. Manish, I want to talk to you about, what decisions from both these two big central banks, the Fed tonight, the BOJ tomorrow, really means for emerging markets and especially India. For example, tomorrow when investors, in this part of the world sort of wake up, what's the likely impact, if there is any impact at all?
I think it'll be a very small impact. And you will have to look at the dollar, because when you look at emerging market, the strength of the dollar, that's the bigger story. Now, you have seen that a lot of long dollar positions have been taken off. If you see in the market is actually slightly short the dollar. So, and today's statement doesn't change that much. So I would not see that there should be a big impact on the emerging market. And respective markets will be driven by what is happening in that particular market. But I don't think macro story and dollar is going to be a big impact on market tomorrow when it opens.
Manish, the other thing is, the fact that the next FOMC statement will be released now on the 15th of June, which interestingly is just 8 days before that Brexit vote. Do you believe at all that the Fed, will not want to rock the boat then? Because at least all three of you sort of agree that perhaps even June now is looking like a distant possibility. But somewhere that's possibly also playing on the Fed's mind. Do you think how much of a consideration will that be?
I think it would be a small consideration, but then you also have to look at what is happening in the Brexit vote. I mean, I personally believe that Brexit is not going to happen. I mean, what you have to take into account, of course, the probability has changed over last week since President Obama's intervention as well. But there was always a big undecided number in all these polls that we're looking at. So when you looked at poll numbers which were 3% in favor of Brexit, you had 15% undecided voters. So, I mean, to me, Brexit is not going to happen from what I see unless things change dramatically over the next 1 month. So it may not be as big a factor, but Fed being Fed, I think they are looking more at their own economy. I don't think that US economy is in the pink of health, that they should go ahead and raise rates. And even talking about inflation, if you look at cumulative inflation, how low it has been compared to 2% target that Fed has, I mean, they can run a 3% inflation for another year or 4 years, and they would still be at the same price level as it would have been if it was running at 2% over the last 4 or 5 years. So I would say that, there's enough room for Fed to not really rush. And to me, as I mentioned before, Janet Yellen's speech at the Economic Club of New York has changed a lot of things for me. And also part of, I do believe that there was some sort of accord as G20 to not let the dollar strengthen. And if you put all these things together, I don't think Fed is running anywhere unless they see a real threat of inflation, which is not there really.
Okay, Nandini, let's pull you into this one, and I want your comments on two things really. One, of course, the outlook for the dollar. Would you continue to say that short dollar really continues to be the trade to be made right now? And also a quick word then on where China sort of fits into all of this, because of late you've seen a little bit of volatility in the Chinese markets as well. One would imagine that since that doesn't seem to have found a mention in the FOMC statement right now, again, should we presume that risks emanating from that region aren't something that will have the markets in a bind?
So to answer the first question on the dollar, I wouldn't say a short dollar trade is necessarily what we're thinking. It's more of, as mentioned earlier, a range-bound outlook for the dollar. So you see a lot of these other central banks, the European Central Bank and the Bank of Japan, very on the forefront of monetary easing, but the effect on the currencies, the yen and the euro, has been muted in the past few events where, they're moving their target away from weakening the currency. And given that those are some of the biggest global crosses, and the fact that our outlook for yen and euro are fairly stable as well, we do have a range-bound dollar forecast for this year. In terms of China, I certainly don't think the risks, the systemic risks in the China growth story and the rebalancing from investment to consumption-led economic transition has necessarily gone away. I do think we are hearing more language from the PBOC and the authorities there that indicate a focus much more on growth at the cost of perhaps some prudential outlook for debt. So it seems like the stimulus or the spending there is much more focused on promoting growth in the near term rather than the long-term debt buildup, which we've seen over the past 10, 20 years has been quite high in China. So I wouldn't say it's out of the immediate concern of investors, but it's more a longer-term systemic risk that we're looking at, just making sure that we're not overexposed to some of the Chinese financial system that are perhaps less stable going forward.
Priya, let's talk about what's expected tomorrow morning then from the Bank of Japan. And, Manish was making this point about how he doesn't remember the last time, not Fed so much, but it was the BOJ that was taking center stage. We know that the Bank of Japan faces immense pressure to ease monetary policy, tomorrow. Do you believe that we're going to see some such move, especially given that, what we're seeing the yen do?
Right. I agree with you. I think the pressure is there. I think the data has not been great, as well as the currency move. And I think the market's very divided because it's not even sure that if the form of easing that they take, what exact impact on the currency does it take? So our view is that they will ease, but that they will not take the deposit rate more negative, because that had such a counterintuitive reaction last time. That they leave the deposit rate where it is, but they will actually do more equity ETF purchases. That they will do negative lending rates, so actually help out banks a bit. I wonder if there's some realization among central banks that if you keep hurting banks, it's ultimately going to hurt credit creation. It's going to hurt the economy. So maybe with all this negative rate talk, let's give something to the banks as well. So that's our call, but it's actually it's extremely uncertain this time going into the BOJ.
Okay, we've also got Invesco's Arnab Das, who's joining in on the phone line. Arnab, thanks for taking time out. First, let's get a reaction from what you've made of, the FOMC decision so far. Rates unchanged, surprisingly, or not so surprisingly, whichever sort of way you look at it. The reference to global risks seems to have been dropped. What did you make of what we've heard? Would you say slightly hawkish?
Well, I think I think it's a bit mixed and so probably neutral, because the prominence of the global risks has been reduced, but the financial market issues have been moved down, but are still there. So I think they've tried to take account of the fact that financial conditions have eased, largely as a result of the dovish tilt the last time around, but they've tried to avoid rocking the apple cart too much. And I think, if we kind of step back from the specifics of the statement and the reading of the tea leaves, the bigger picture here is that a shift in policy or even the policy rhetoric that is significant requires probably a revision of the forecasts and a bit more of verbiage with the market, right? So probably would occur on quarter end rather than within the quarter.
Right.
So I think.
And I'm sorry if I can just interrupt. When you mean forecast, do you mean rate forecasts, or do you mean like economic forecasts?
Well, both, but
Okay.
particularly the economic forecast that would justify a change. So you'll remember that, of course, the last time around they brought the dot plots a bit closer to the market, right? And the market priced out the rate cuts even further. But so it has to do with the dots and the FOMC's forecasts, individual members' forecasts of where they see rates going. But that, of course, in turn is has to be in substantial part a function of where they see the economy going, and so that probably requires a change in the economic forecast, or at least a recasting of what's going on in the economic story. So on net, anyway, if you take all these things together, I think it's a more or less neutral rendition. It's not more dovish than it was, but it's not really significantly more hawkish than the statement was the last time around.
Okay. So what's your own expectation then? When do you see that we're going to see the first rate hike? Is it going to be June at all? Because at least everybody else on this panel seems to think that it's only going to be July. What's your own sense?
Well, I think June is certainly live, but I think it is really data dependent, and I think it's also still market dependent. I think none of the underlying issues has been resolved in the global economic picture, whether that's the deflationary or disinflationary pressure in Europe or Japan, or the credit issues and growth challenges in China. And if anything, the credit stimulus, fiscal stimulus, and primarily the credit stimulus in China has helped, stabilize emerging markets, has contributed to a demand lift for EM and also for commodities. But that, of course, has made the underlying issue of credit creation and possibly the NPLs a more significant problem in China than a few months ago. But indeed, today or yesterday, I guess it was, the IMF has sort of in effect drawn attention to that problem. So I think it's still very uncertain, very much data dependent, and I think the two main driving forces, not the only ones by any means, but the two main macro driving forces are the risk of upside surprises in the United States and downside surprises in China.
All right, we'll leave it at that. All of you, thanks so much for taking time out for us. Manish Singh, Nandini Ramakrishnan, Arnab Das, and of course, Priya Mishra. So there you go, as expected. The Fed not moving on rates, but keep in mind, as our panelists were saying, it's turned out to be a bit of a mixed statement really coming in. So while they're enthused with what's happening on the inflation front and the labor market, risks, of course, remain to the economic outlook in the United States. But surprisingly, they've actually said that they don't see too many risks emanate, at least from the global side. But with that, we'll wrap it up on this edition of Smart Markets. Thanks so much for watching. Do stay tuned to ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.